Hey everyone, Mo Param here from Asset Management Group, and I have some big news to share for you. The biggest federal tax overhaul of the decade just took effect in July of 2025, and it's packed with game-changing breaks that could save you thousands or cost you a fortune if you don't act fast. Are you curious? Stick around because this isn't just another tax update. It could be the smartest money move you make all year. If you want clear facts, no hype, no politics, hit that subscribe button for more amazing videos like this. So let's dive in. Why this bill matters. So let me give you a little backstory so you can understand why this bill is so important. So in order to do that, you need to know what happened before it was passed. The Tax Cuts and Jobs Act of 2017 was a landmark legislation that lowered taxes for individuals and corporations alike. Think of 2017 law as a major tax sale. It reduced rates across the board, but with an expiration date, like a store promotion that was set to end. Corporate tax rates were slashed from 35% down to 21%. Individual tax brackets adjusted with lower rates overall. Significant expansions of deductions and credits, including for small businesses and self-employed individuals. But there was a catch. Many of these tax breaks were temporary and were set to expire by the end of 2025 unless Congress acted. Without action, millions of Americans would have faced automatic tax increases in 2026. This new bill extends many of those tax changes at least through 2030, making some permanent and introducing new provisions with immediate effect starting January of 2025. The overall goal is to sustain economic growth, boost American competitiveness, increase your take-home pay, and incentivize companies to invest more in capital and growth. So whether you're an employee, business owner, or retiree, these changes directly affect how much money stays in your pocket versus going to the government. So here are some key tax breaks you should know about. Number one, no tax on tips. One of the most eagerly awaited parts of this new law is the elimination of federal income tax on tips. Yes, every dollar of your tip income could be yours to keep without federal taxes taken out under certain conditions. So if you work in restaurants, bars, hotels, drive an Uber or Lyft, deliver food, or any job where customers tip you, this could be a huge take-home pay for you. So this applies from January 1 of 2025 through December 31st of 2028, after which this may be reassessed. Remember, permanent doesn't mean permanent all the time. There's a limit. Up to $25,000 of your tip income per year is tax-free. Both cash and credit card tips are included, a big relief for many who are worried about electronic tip tracking. Now, there are some income limits. So if you're a single filer earning more than $150,000 per year, you can start losing this benefit. Joint filers earning more than $300,000 per year start losing this benefit as well. Even if you receive a W-2 paycheck that includes tips, you can still claim this as a benefit. So let me give you an example. Let's say you're a server who makes $20,000 in tips per year. Before this law, you would pay federal income tax on the entire $20,000, maybe $24,000 or $4,000 depending on your tax bracket. But now you pay zero federal income tax on those tips. That's thousands of dollars staying in your pocket. Now, you still need to report your tips to your employer and for Social Security and Medicare taxes, but this eliminates the federal income tax portion. Number two, no tax on overtime pay. If you work more than 40 hours in a week, the extra money you earn, the overtime pay, you can now deduct that from your taxable income up to a limit. When you work more than 40 hours, your employer must pay you time and a half. So if you normally make $20 an hour, overtime pays you $30 an hour. That extra $10 an hour, your overtime premium, is now tax-free up to a certain limit. This applies to overtime hours worked and paid weekly beyond 40 hours. Only the overtime portion, that premium, is tax exempt, not your entire paycheck. So for example, let's say you normally make $20 an hour, overtime pays you $30 an hour, that extra $10 an hour is now tax-free. Now here are the limitations. If you're a single taxpayer, the deduction limit is $12,500. If you're married filing joint, that's $25,000. And the income is phased above $150,000 for single filers and $300,000 for married joint filers. Now, critics note only about 8% of hourly workers and 4% of salary workers earn qualified overtime. But for those eligible, that's a direct tax savings on extra hours worked. So here's an example. You're a factory worker making $25 an hour, $37.50 if you're working overtime. You work 10 hours of overtime per week for a full year. That's $19,500 in overtime pay, with $97.50 being the premium portion. Under this law, that $97.50 is tax-free, saving you roughly $1,500 to $2,400 in federal taxes. Number 3, the $40,000 state and local tax deduction. Perhaps the most headlining, grabbing, and controversial aspect is this massive increase in the SALT deduction limit. SALT stands for state and local taxes. This includes state income taxes, property taxes on your home, and local taxes you pay to your city or county. Before 2017, you could deduct all state and local taxes from your federal return, no limit. From 2017 to 2024, it was limited to only $10,000 total deduction. That's a huge burden for people in high tax states. 25 to 2029, the limit was raised to $40,000 and it's going to be indexed for inflation. So who does this help? Residents in high tax states like California, New York, New Jersey, Connecticut, and Illinois. If you live in these states and own a home, you probably hit the $10,000 limit easily. So let's say you live in New Jersey. You pay $15,000 in property taxes and $20,000 in state income taxes. That's a total of $35,000. Under the old rule, you could only deduct $10,000, losing out on the $25,000 in deductions. Under this new rule, you can deduct the full $35,000. Talk about a tax savings. That's roughly $6,000 to $9,000 depending on your tax bracket. Now, there is a phase-out period. The deduction starts to reduce over income above $500,000. Now, there's some advanced strategies to work around the SALT cap. A little known but widely adopted state-by-state strategy lets taxpayers bypass limits legally. Business owners who run S-corps or LLCs might pay state taxes at the company level and claim a deduction on the business rather than on their individual returns. So far, 30 states have approved such strategies. So if you live in a high tax state and make over $500,000, this strategy could save you tens of thousands in taxes. Number 4, the lower tax rates are staying and they're going to be indexed through 2029. The U.S. income tax brackets ranging from 12% to 37% will remain intact through 2029, and it's going to index annually for inflation. Without this extension, tax rates would have automatically increased in 2026. The top tax rate would have jumped from 37% back to 39.6%. Each year, the income levels for tax bracket will adjust upward for inflation. This prevents bracket creep, where inflation pushes you into a higher tax bracket even though your purchasing power really hasn't increased. Nearly all taxpayers can expect their after-tax income to gradually increase as inflation adjustments reduce their taxable income percentage-wise. So for example, if you're in the 22% tax bracket, that starts at $50,000 this year. Next year, it might start at $51,500 due to inflation adjustments. This means that more of your income is taxed at lower rates. Number 5, mortgage interest deduction. The mortgage interest deduction remains intact up to $750,000 for a loan on your primary residence. So how does this work? If you have a mortgage, you can deduct the interest you pay each year from your taxable income. This applies to mortgages up to $750,000. So if you borrowed more than that, you can only deduct the interest on the first $750,000. So as an example, let's say you have a $750,000 mortgage at a 6% interest. That generates about $45,000 of annual interest paid. This amount is potentially deductible from your income. And if you're in a 24% tax bracket, that's about $11,000 in tax savings per year. Now, mortgage insurance premiums, PMI, are also eligible for deductions. So this benefits Any homeowner who's looking to buy or refinance homes in today's environment of high interest rates, as the interest payments and therefore deductions are larger. Number 6, permanent 100% bonus depreciation for businesses. One of the biggest wins are for business owners. The 100% bonus depreciation benefit was scheduled to phase out gradually, dropping to 80% in 2023, 60% in 2024, and etc., and it was disappearing at the end of this year. Now this law makes it permanent at 100%. So what's bonus depreciation? So normally when a business buys expensive equipment, they have to depreciate it, meaning they can only deduct a portion of the cost each year over several years. Bonus depreciation lets you deduct 100% of the cost immediately. So think about it. Equipment and machinery, vehicles over 6,000 pounds like business SUVs and pickups, computer equipment and software, certain real estate improvements. The impact of this is huge. This can boost cash flow dramatically and lower taxable income immediately. So let's say you buy a $100,000 piece of manufacturing equipment. You can deduct the full $100,000 this year instead of $20,000 per year over 5 years. Business used vehicles over 6,000 pounds can be fully expensed. Certain commercial property improvements can now be deducted up front. So business owners of companies with high capital expenditures, manufacturers, logistics firms, construction companies, tech companies, especially stand to hugely benefit from this bill. Number 7, an increase in standard deduction. The standard deduction for 2025 is set at $15,750 for single filers, $31,500 for married filing jointly. So you may ask yourself, what's the standard deduction? Well, the standard deduction is the amount of income you can earn without paying any federal income tax. It's automatically subtracted from your income before calculating taxes. And this matters, okay? This is a noticeable jump that reduces taxable income broadly, even for those who don't have enough itemized deductions like mortgage interest or charitable donations. And so for all you middle-class taxpayers, this is great news because you can take full advantage of the standard deduction. A higher standard deductions means less of your income subject to tax. Number 8, the 20% qualified business income deduction has become permanent. Pass-through businesses, S corporations, partnerships, LLCs can now take a deduction of 20% of their qualified business income, reducing the tax liability significantly. This deduction is now permanent. Pass-through entities, these are businesses where the profits pass through to the owner's personal tax returns instead of the business paying corporate taxes. This includes most small businesses, freelancers, and professionals. So how does the 20% deduction work? So let's say if your business makes $100,000 in qualified income, you can deduct $20,000, so you only pay taxes on $80,000. Okay, so let's say you run a consulting LLC that makes 200 grand. You can deduct $40,000 and only pay taxes on 160. If you're in a 24% tax bracket, that's almost a $10,000 in tax savings. Now, there are some complex rules about what income qualifies and income limits where deductions phase out, especially for service businesses. This can result in substantial tax savings for millions of entrepreneurs, small businesses, and professionals. Number 9, 1099 reporting thresholds have been raised. Small businesses and individuals now can pay up to $2,000 per person per year without triggering a 1099. When you pay someone for services, not an employee, you have to send them and the IRS a 1099 form if you pay more than a certain amount. The threshold increased from $600 to $2,000. This matters big because before this change, any payment over $600 required formal IRS reporting and tax documentation. Now, this helps reduce paperwork for your gig workers, freelancers, and businesses relying on independent contractors. Small businesses can now hire contractors for smaller jobs without the administrative burden of the 1099 paperwork. Now, there are some small provisions that you need to know, like deducting interest on personal car loans. Now, starting in 2025, interest paid on personal auto loans becomes deductible, something completely new. Previously, you could only deduct car loan interest if you used the car for business. But but now you can deduct interest on personal car loans under certain conditions. Now, there are some requirements here, okay? This applies only to cars manufactured in the United States. The deduction interest is capped at $10,000 annually. Now, there are certain requirements that need to be met. First, this applies only to cars manufactured in the United States. There is a cap. You can deduct up to $10,000 annually. And there's also an income limit, okay? The benefit starts to phase out if you go over these limits. So if you're a single taxpayer, if you go over $100,000 per year, the benefit phases out. And if you're married filing joint, if you make over $200,000, the benefit starts to phase out. Real world example is, the average car payment now in the United States is around $742. The average loan size is about $41,500 at an interest rate of about 6.35%. On a typical car loan, you might pay $2,000 to $3,000 per year in interest. So if you buy a Ford F-150 with a $40,000 loan at 7% interest, in the first year you pay about $2,800 in interest. If you qualify, you can deduct this from your taxable income, saving you $400 to $700 in taxes depending on your bracket. Number 11, the end of the $7,500 EV tax credit. For several years, buyers of electric vehicles earning under $150,000 if you're single or $300,000 if you're married could claim a $7,500 federal tax credit. This is now scheduled to expire earlier than planned on September 30th, 2025. Now, there's a difference between a tax credit and a deduction. Unlike a deduction, which reduces your taxable income, a credit directly reduces your tax bill dollar for dollar. A $7,500 credit means $7,500 less in taxes owed. So, if you've been considering purchasing an EV to claim the credit, time is running out. You need to take delivery by September 30th of 2025. So who qualifies? Well, if you're single and you make under $150,000, or if you're married earning under $300,000, you qualify. And the vehicle must meet certain manufacturing and price requirements. So again, if you're thinking about buying an electric car, do it before September 30th. That could save you $7,500. Senior citizen increased standard deduction. Now this is big. This is big. For taxpayers over 65 years old, an extra $6,000 of standard deduction applies through 2025 through 2028. Now, how does this work? If you're 65 or older, you get the regular standard deduction plus an additional $6,000. So now think about this. If you were a single filer over 65, you would get the $15,750 of standard deduction. Add another $6,000 for that senior bonus. That's $21,750 in total standard deduction. Now this phases out starting at $75,000 for singles and $150,000 for married couples. Now this provides tax relief for Social Security recipients and seniors with modest income, helping them shield more of their income from taxes. Number 13, the $1,000 Trump account for children. Now, the government will deposit $1,000 into an investment account for every child born in 2025 through 2028. How does this work? The government contributes $1,000 automatically for each qualifying birth. Parents can add up to $5,000 per year for each child under the age of 18. Funds can grow with compound interest. Think about like investing in mutual funds, individual stocks, bonds. And the money can be used tax-free for first-time home buyers, higher education, and startup costs for business. Any unused funds will be taxed as ordinary income when you cash out. Now, this is similar to an education account like the 529, but broader in scope. It's designed to encourage early saving and wealth building for the next generation. So let's take a look at this. $1,000 deposited that grows 7% annually for 18 years becomes about $3,400. If parents contribute the $5,000 annually, that account could be worth over $200,000 by the time that child reaches 18. Now, what's the big picture? The bill is estimated to add $2.9 trillion to the national debt over the coming decade and reduce federal tax revenue by roughly $4.5 trillion. Critics argue these large deficits threaten economic stability. They also say that phase-outs and deductions benefit high earners disproportionately. Now, those are the critics. Now, supporters argue that economic growth will be spurred by these tax incentives, which partially offset revenue loss through increased economic activity. Incentivizing investment and high incomes benefit the overall economy. Now, let's see who wins and loses. The bottom 20% of taxpayers might see a net cost of $560 per year. The top 20% could receive tax savings around $6,000 per year. However, since the top 50% of earners pay 97% of all income taxes, benefits tend to flow to these paying the most taxes. Now, what should you do? The bottom line is these tax law changes are real, they are big, and they are effective immediately in many cases. So, take some immediate action. If you earn tips or overtime, understand how the new exemptions work and adjust your tax planning accordingly. If you live in a high tax state, the increased SALT deduction could save you thousands. Make sure you're taking advantage of it. If you own a business, talk to your accountant about bonus depreciation and QBI deduction strategies. If you're considering major purchases, EV buyers, act before the credit expires this fall. Car buyers in general, consider whether a US-made vehicle with financing makes more sense for the interest rate deduction. If you're thinking about buying business equipment, take advantage of the 100% bonus depreciation. And as always, talk to your accountant or tax professional before the end of the year to plan your capital spending, R&D investments, deductions, and the timing of your income. Explore strategies like the SALT cap workaround if you qualify. Keep track of bonus depreciation and QBI deduction rules if you're a business owner. Consider the timing of income and expenses to maximize benefits. The tax landscape is complex and evolving. Understanding these provisions can save you thousands and improve your financial future. Thanks for watching, and if you find value from this detailed breakdown, hit that like button and subscribe for more practical, factual finance insights. I'll see you next time.